For thousands of years, precious metals have represented wealth. Empires stored them. Investors trusted them. And during economic uncertainty, people still run toward them. Gold, silver, platinum, and palladium have always held a special place in financial markets. But trading precious metals today isn't the same as simply buying gold coins and storing them in a safe. Modern markets allow people to trade metals through futures, ETFs, mining stocks, and digital platforms. That creates opportunities, but also risks. So how does precious metal trading actually work? And why do so many investors turn to gold during uncertain times? Let's break it down. Precious metals have two unique qualities that make them attractive in financial markets. First, they are scarce natural resources. Second, they have been recognized as stores of value for centuries. Unlike paper currency, which governments can print in large quantities, metals like gold and silver must be mined from the earth. This scarcity gives them intrinsic value. Because of that, investors often view precious metals as a hedge against inflation, currency weakness, and economic instability. But understanding why metals matter is only the first step. The real question is how trading them works in modern markets. Why gold is the most popular metal? Gold is by far the most widely traded precious metal. Its popularity comes from several factors. Gold is durable. It does not corrode. It has limited supply growth, and it has been used as money throughout history. Central banks around the world still hold massive gold reserves as part of their financial security. Because of this historical role, gold often rises in value when investors lose confidence in traditional financial systems. During periods of inflation, geopolitical tension, or economic uncertainty, demand for gold tends to increase. This reputation as a safe haven asset is one of the reasons traders pay close attention to gold markets. Other precious metals in trading. While gold dominates headlines, other precious metals are also actively traded. Silver is the second most popular metal among investors. Unlike gold, silver has strong industrial demand. It's used in electronics, solar panels, medical devices, and many other technologies. This means silver prices often react not only to financial markets, but also to manufacturing activity. Platinum and palladium are also significant metals in global markets. Both are used heavily in the automotive industry for catalytic converters that reduce emissions. Because of this, their prices can fluctuate based on car production, environmental regulations, and supply disruptions. Each metal has its own market dynamics. Understanding those dynamics is crucial for traders. Different ways to trade precious metals. One of the biggest changes in modern investing is the variety of ways people can gain exposure to precious metals. The most traditional method is physical ownership. Investors buy gold bars, coins, or silver bullion and store them securely. This method provides direct ownership, but also requires storage and insurance. Another common approach is exchange-traded funds, often called ETFs. These funds track the price of metals like gold or silver and trade on stock exchanges. They allow investors to gain exposure without physically holding the metal. Futures contracts are another major trading method. Futures allow traders to buy or sell metals at a predetermined price on a future date. These markets are highly liquid and widely used by professional traders and institutions. Mining stocks offer another indirect way to invest. Instead of buying the metal itself, investors purchase shares in companies that produce it. When metal prices rise, mining companies often become more profitable. However, mining stocks also carry business risks that metals themselves do not. Each approach offers different levels of risk, liquidity, and complexity. What drives precious metal prices? Precious metal prices are influenced by several major factors. One of the most important is inflation. When inflation rises and currencies lose purchasing power, investors often buy gold and silver as protection. Interest rates also play a major role. When interest rates are high, assets that generate income, like bonds, become more attractive than metals that produce no yield. But when rates are low, the opportunity cost of holding gold decreases. Currency strength also affects metal prices. Gold is typically priced in US dollars. When the dollar weakens, gold often rises because it becomes cheaper for international buyers. Geopolitical events can also trigger price movements. Conflicts, political instability, or global uncertainty often push investors toward safe haven assets like gold. Finally, supply and demand dynamics matter. Mining production, industrial demand, and central bank purchases all influence market prices. The role of precious metals in a portfolio. Many investors don't trade precious metals actively. Instead, they include them as part of a diversified investment portfolio. Precious metals often behave differently from stocks and bonds. During stock market downturns, metals sometimes hold their value or even rise. This makes them useful for diversification. By holding a small percentage of a portfolio in metals, investors may reduce overall risk. However, metals are not perfect hedges. Their prices can be volatile, and long periods of flat performance are possible. That's why most financial professionals recommend moderation rather than heavy concentration in metals. Risks of trading precious metals. Like any financial market, precious metal trading involves risks. Prices can move quickly and unpredictably. Short-term speculation can lead to significant losses. Futures trading, in particular, involves leverage, which can amplify both gains and losses. Mining stocks carry additional risks related to company management, operational issues, and geopolitical factors where mines are located. Even physical ownership has risks, such as storage costs and potential theft. Because of these risks, investors often approach precious metal trading with careful planning and risk management strategies. Why metals remain relevant. Despite the rise of digital assets and complex financial instruments, precious metals remain relevant in modern markets. They represent tangible wealth. They cannot be printed or created electronically, and they have thousands of years of historical trust behind them. During times of financial stability, metals may not attract much attention, but during uncertainty, they quickly return to the spotlight. This cyclical interest keeps precious metals an important part of the global financial system. For many investors, precious metals serve as a form of protection. For traders, they offer opportunities driven by global economic trends. But like any investment, success depends on knowledge, patience, and discipline. If you found this breakdown helpful, hit the like button so more people can discover it. Subscribe for more insights on financial markets, investing strategies, and how global economic forces shape the assets people trade. And remember, gold and other precious metals may be ancient, but their role in modern finance is far from over.